The Trump election marked a turning point for global fixed income generally, and particularly for emerging markets. Whether President-elect Trump's election campaign promises of massive fiscal stimulus packages becomes a reality is yet to be seen. However, even a more watered-down version is likely to be deflationary and a negative overhang on global fixed income. Hence, the year 2017 will likely mark the end of the long-run secular bull market in fixed income. In addition to potential deflation from increased infrastructure spending and tax cuts, emerging markets fixed income is also vulnerable to restrictive and protectionist trade policies, lower global trade overall, and a stronger US dollar. In this environment, we are much more cautious in our outlook on the asset class. For 2017, we're projecting overall emerging market returns of around 2.75% to 3%, broken down to around 4% for high yield and around 2% for investment grade. Since the election, US Treasury markets have reacted negatively in almost parabolic fashion to higher inflationary expectations under a more fiscally aggressive Trump presidency. We think that the reaction is a bit too far, too fast, as policymakers are cognizant that a too fast run-up could choke off the US economic recovery. Nonetheless, over the near term, we believe that yields are still biased towards the upside, and as a result, would advocate that clients pair portfolio duration to perhaps a quarter to a half a year below the index. In 2016, Latin America was the top performer after strong performance from Asia the previous year. For 2017, we believe that Europe and the Middle East is poised to be the top geographic outperformers. Under a Trump administration, the relationship with Russia is poised to improve, which could ultimately bear fruit with the easing of sanctions. Meanwhile, in the GCC, a tilt away from the Iran-centric policies of the Obama administration would benefit the Sunni axis of Saudi Arabia, Qatar, and Turkey. On top of the geopolitical angle, CEMEA credits sport the strongest credit metrics globally. Conversely, Latin America and Asia both appear vulnerable to trade tensions amidst a more protectionist US economic policy.